Hello, and welcome to the Three Questions podcast, where we dive deep into the world of wealth management and connect you with industry experts. I'm your host, Wayne Baxter, Senior Executive Manager at One Capital Management. Are you or someone close to you a Canadian entrepreneur looking to expand your business? If so, stay tuned. We're going to address the three questions entrepreneurs should ask about expanding their business while not compromising their cash flow. Thank you for taking time to check us out. And if you enjoy this episode of the Three Questions podcast, please consider liking this video and subscribing to our podcast and YouTube channels. Being an entrepreneur can be incredibly rewarding. I love entrepreneurs. What being an entrepreneur does is it allows you to turn your passion and your ideas into a tangible reality while creating value for others. And it offers the freedom to chart your own course, solve meaningful problems, and experience personal and financial growth. That journey, though challenging, brings a profound sense of accomplishment and fulfillment. Today, we're going to focus on one of those challenges as we address the three questions entrepreneurs should ask about expanding their business while not compromising their cash flow. Joining us from beautiful Vancouver, British Columbia is Micheline Varas. Micheline is a senior partner with Customplan Financial Advisors, and what she does is specialize in formulating comprehensive cost and tax-effective risk mitigation plans. It's a mouthful, but she's an expert. With her team of experts, Micheline structures financial maps, ensuring personal and corporate risks and taxes are relieved. And I'll say this, in my opinion, Micheline is one of the preeminent insurance specialists in all of Canada. Micheline, I know how busy you are. I really want to thank you for making time to join us today. Great to see you.
Great to see you too. And thank you for the kind introduction. Wow.
Micheline, we actually go back about, I hate to say this, I guess, 20 years almost.
Yeah, about that. Yeah.
Back in my IPC days. We on previous this is on episodes you were on, obviously, we've highlighted many topics Canadian entrepreneurs need to consider when they're expanding or doing business in the U.S. And that included transfer pricing, building good working relationships, protecting their reputations and their sales. Also talked about sales tax. And just for those listening in, I would encourage you to check them out. You can find them on our website or on your Apple or Spotify podcast tools that you use. Today, what we're going to do is we're going to dig into cash flow strategies that entrepreneurs can use to expand their business. So we're going to be a little bit technical today, but I mean, just from your perspective, maybe you can just share a little bit on your thoughts in terms of, the strategies that people can use and how they can be effective.
Now you're talking about expanding a Canadian business into the U.S.?
Yes.
Well, many look to doing that. And it actually involves several steps ranging from business structure to tax planning. So I think individuals need to really carefully consider how they set up operations in the U.S. to optimize tax situation. More importantly, to avoid double taxation and to take advantage of tax treaties, which may be changing with the new regime, but for the time being, right? So when we speak about financing and expansion, you can use capital in your Canadian business to fund that expansion. And there are quite a few different ways of doing that. Now, I'm an insurance geek, so I will speak to that, but that's not the first and foremost answer. You can look to debt financing. So you could loan funds from a Canadian business to a U.S. subsidiary. Now that may be beneficial if the U.S. subsidiary can deduct interest expenses on the loan. Another consideration could be equity financing. So your Canadian business can provide equity to its U.S. subsidiary by purchasing shares. But then that could also lead to potential double taxation of the profits. So you'd have different tax implications other than just debt. And then what I said, I wasn't joking. I am a bit of an insurance
Just a
geek.
bit of an insurance geek there, Micheline, right?
I
Just
I
ever so
am,
slightly.
and I like to use insurance not necessarily for what most people think that it does, meaning the benefit that it provides upon
Death
passing.
benefit,
I
exactly.
I like to use it for all of the things that you can play with and looking to its benefits while you're still walking this planet. So, while there's nothing in life that's free, sometimes costs that are paid into insurance are low relative to the benefits that are incurred. So, in this situation, it may actually be prudent to consider a vehicle. Now, this vehicle happens to be have an insurance wrapper in which monies are invested. So, in this case, it would be corporate retained earnings are invested in this vehicle, but then immediately borrowed back. And they're borrowed back by the Canadian operation to be used for its development and its further investment. So in this example, it would be to start up a US subsidiary. So it not only allows for life insurance to be purchased without reducing any available cash flow, but particularly in corporate situations, it gives access to retained earnings that can be reinvested appropriately.
You know, we were talking before we went on the air, and you just basically reaffirmed my comment. And that is, I'm going to use the Home Depot analogy again, if you don't mind. And
Not
you
at
just,
all.
so, a friend of mine told me many years ago, he said, I didn't go to Home Depot because I wanted to shovel. I went to Home Depot because I wanted to dig a hole. And I think we could basically say the same analogy with insurance. Nobody really wants to own insurance for the sake of owning insurance. They own insurance because it solves a problem. And what you've just did is articulated perfectly the reason why somebody would want to own insurance. And in this case, interestingly enough, while obviously there needs to be a need for life insurance at the end of the day, we're also solving another problem that has nothing to do with someone passing away.
Yeah,
So,
exactly. The strategy actually that we're using in this situation is referred to as an IFA, an immediate financing arrangement. And that's where an insurance policy is purchased. It's a permanent policy, and a permanent policy because it has built within it an investment component, and that investment grows on a tax sheltered basis. So you invest monies that are more than the pure cost of the insurance.
exactly.
Those monies grow on a tax sheltered basis, but then you use that policy immediately as collateral for a line of credit, in this case with a Canadian financial institution. Now,
Right.
that line of credit, as all are, is tax free. So first and foremost, you've just allowed access to retained earnings on a tax-free basis. So now the loan is used corporately by the business to produce income, or in this case, to fund its US subsidiary.
Beautiful. Okay, well, we're going to be discussing the three questions entrepreneurs should ask about expanding their business while not compromising their cash flow. And we're going to, again, focus on Canadian entrepreneurs looking into the US. So let's get right to it. First question, again, these are the questions from the lens and the view of the entrepreneur. So, question number one, I have an opportunity to expand my business into the US and want to utilize the capital in my business. How do I do this while minimizing my tax bill? Micheline, take it away.
The first thing I would say with respect to using capital in a Canadian business, debt financing. So you could loan funds from your Canadian business to the US subsidiary. So that's one way of doing it for sure. It could be beneficial again if the US subsidiary can deduct the interest expenses on the loan. So that's number one. Number two would be equity financing. So your Canadian business could then provide equity to its US subsidiary by purchasing shares. Um, that, as I said before, could lead to potential double taxation of profits. So you've got to balance out those tax implications, right? Which is the lesser of the two evils? And you could certainly use an insurance wrapper. So as we were speaking earlier, that IFA concept, that immediate financing arrangement, whereby insurance can be purchased, the corporation can contribute monies over and above the pure cost of insurance into this plan, into this solution. Those monies grow tax sheltered, but they are leveraged immediately with a Canadian financial institution. So in leveraging that, the corporation then receives a loan that can be used by the business to either produce income or to fund its US subsidiary. Now, every year, interest is going to have to be paid on the line of credit using the collateral insurance deduction, but the interest expenses are 100% deductible from current income. So there are tax savings obtained from deductions, both from the pure insurance side as well as from the interest payment.
So I guess that leads to another question, and it's, you know, for some business owners, this is going to be the first question they're going to say, okay, this sounds like a great idea, but is there any benefit to me to expediting paying off that debt? You know, say my business does really well and I don't like the idea of carrying this debt. Is there any benefit to paying it off sooner as opposed to letting it to continue to sort of accumulate and grow over the duration of the life of the?
You could absolutely. People choose to do things, and there is enough flexibility within these plans where you can actually pay back the debt. So the way that the insurance companies and the lenders look at it is has a direct correlation between the cash value within the policies and the loan amount. Now you have to remember that those cash values are growing with interest or dividend interest in a tax sheltered basis. So the amount that's of the gross is a net amount.
Right.
So you will always have more cash value than you will loan. So at the
Yeah,
end of the
that's for
day,
sure.
you can actually take out cash value and repay the loan.
Or even from outside of the policy, if I just say I don't want to have this debt, I just want to pay it down. You could
You
in
can
theory
do
do
that
that.
as well. You absolutely could do that as
Right.
well.
I just know that there's going to be a segment of the listening audience that when they hear debt, all the alarm bells go off, and even so, just to give them sort of a sense of ease and comfort that if they felt they wanted to pay down that debt, they're not
Well,
subject to.
it can be paid in several ways. So, in time as cash flow increases, or upon the passing of the individual, if they want to wait until they've passed, um, then basically what's going to happen is that the insurance proceeds together with the cash value will be paid to the corporation.
Which is the most
The
common method, right? That's the
It
one
is
I'm
the
most
most
familiar
common
with.
method because that's done with, again, insurance proceeds, which are tax-free. They
Right.
come into the corporation, they flow through the capital dividend account of the corporation. And first and foremost, there will be that amount that's owed to the bank. So the loan amount will be paid by the proceeds of by the cash value, basically. Um, and then the balance, any amounts in excess of the loan, would be distributed to the beneficiaries.
Yes.
Now, so should the loan proceeds be reinvested into the business and taxed at a marginal rate, a portion of that interest is going to be deducted anyway.
So again, these are not sort of boilerplate strategies, that every case is unique into themselves. So this is something where you want to work with an expert like Micheline, and obviously having a really savvy tax advisor as well will be really helpful. Micheline Varas joins us from Vancouver, British Columbia. Again, she calls herself an insurance geek, and she wears it in a good way. And I really appreciate her joining us today. We're asking the three questions that entrepreneurs should ask about how to expand their business without impacting their cash flow. And we're going to get into question number 2, again, from the entrepreneur's perspective. I am looking to diversify business assets and take advantage of a business development opportunities in the U.S. How can I access my retained earnings efficiently? Micheline.
Oh, okay. Well, I think choosing the right business structure in the US should be the first decision. So I'm going to give you the non-insurance answer or consideration. And then again, I'm going to go back to an insurance solution because admittedly, that's what I look to. But as you said, Wayne, first and foremost, I think every business owner who's operating on both sides of the border should surround themselves with people who are
Do
savvy.
not want to be a
So,
do-it-yourselfer here at all. Absolutely
so
not.
yeah, do yourself the courtesy of consulting those who know and are knowledgeable in tax venues on both sides of the arena. That's inclusive of lawyer, accountant, financial advisor, because there are structures which work in one country and are not necessarily favorable in the other, and vice versa. And some, if well positioned, can really do well by the business owner. So I would say first and foremost, choose the right business structure in the US. So you could consider a branch office, and that's when your Canadian business directly operates in the US without having to set up a separate legal entity. Um, Now, US tax authorities would treat that US branch as part of the Canadian company, which could potentially expose you to US taxes on income earned in the US. But again, it's one consideration, right? So it's very dependent. You could look to a US subsidiary. So often setting up a separate US corporation allows for you to isolate the Canadian business from the US operations. So you'd pay US corporate tax on income generated in the US and dividends then paid from the US subsidiary to the Canadian parent company could be subject to withholding taxes. Again, you need accountant and lawyer involved. Limited liability companies, a little bit more flexible a structure because they're treated as a pass-through entity for tax purposes. But then again, it's very, very difficult to say which is the best solution. And we have to take into consideration tax treaties between Canada and the US. So right now, our respective countries have a tax treaty that helps to avoid double taxation on income earned in both countries. So if it's dividends paid from a US subsidiary, then there is a certain rate. There are business profits that are generally only taxable in the country where the business is located. There are corporate tax considerations in the US, both from a federal and state tax perspective. So you have to sort of take all of those things into consideration, and it would be very difficult to give counsel from a broad base without knowing in which state, et cetera, et cetera. Some states like Texas and Florida don't even have state level income taxes. So that could be beneficial for an expansion as well. But it would be very, very difficult to comment. You can repatriate profits to Canada. So if your U.S. subsidiary generates profits and you want to bring those back into Canada, you would need to plan for dividend repatriation. So under the current U.S. Canada tax treaty, the U.S. would withhold taxes on dividends to the Canadian parent, but that tax can be reduced if you own a substantial percentage of that U.S. subsidiary. So again, a lot of things to take into consideration.
And you didn't even mention the other thing that's now a new one, which is the Corporate Transparency Act here in the U.S., where now you have to make sure that you report any changes within the structure of that business. First of all, if you're starting a new business, you have to register with FinCEN within 90 days. And I believe starting in 2025, it's going to be 30 days. And then when you make any change to the corporate infrastructure of that business, you have to update that Corporate Transparency Act document that you have to complete. So that's another layer of complexity that I'm going to add to what you just brought to the table. So again, you definitely want to have CPAs in both countries, or a very knowledgeable cross-border CPA that knows both U.S. and Canadian personal and corporate tax. And also, again, you're going to want to have representation from an attorney, a lawyer, probably, again, in both countries as well. So this is very complex, and that's why we're having this discussion, just to make sure everybody is aware of what is involved.
Yeah, there are also other U.S. taxes, and of course, when you know that better than I do, but you've got sales tax. So if your U.S. subsidiary sells goods or services, it may be required to collect sales tax. You've got employment taxes. So if you hire employees in the U.S., you would be subject to U.S. payroll taxes, Social Security, Medicare, all of the unemployment taxes, and compliance, our favorite word. So you've got tax filing in the U.S., the corporate income tax return, which I believe is Form 1120. So you'd have the Canadian parent company that also has to report its U.S. subsidiaries' income on its Canadian tax return. And then you have to adhere to U.S. compliance and state compliance. So we're back to the consult your professionals.
100%. So now let's talk about insurance. How does insurance play a role here?
Now, insurance plays a huge role, and we're back to the same type of structure that we used before. We can look at, again, one of those leveraging arrangements, because that allows a corporation to access retained earnings on a tax-free basis to then invest in the U.S. So since we've talked about that, I don't want to get into that again, just from that perspective, but there are other insurances also to consider. Critical illness cover, which is more popular here in Canada than it is in the US. And I say with pardonable pride that Canada has actually the best critical illness cover that's available worldwide, and that's because of the guarantees that we have built into our product. So the Canadian product actually has or offers level coverage, whether it's to your age 65, 75, or to age 100, and it also can have built within it return of premiums, assuming that nobody claims, which is a great thing to have.
I you get to fund the policy for 15 years, right? Is that the minimum?
Yeah, depending on the companies, it could be anywhere between 10 and 20 years. Usually 15 is a sweet spot. And it's much like wearing a Superman cape, because none of us want to even consider the possibility of being diagnosed with one of these critical illnesses.
You call it covered conditions still, right?
Exactly. So basically, if these plans are set up properly, and I like to call them split dollar arrangements, whereby the corporation is paying for one portion and the individual shareholder or key employee, whatever, in this case, shareholder, is paying for the benefit of having that return of premium paid back to them. So they're actually T4'd for that amount. So how is that beneficial? Because basically your corporation is paying for these costs using retained earnings. And after a 15-year time factor, let's use the 15-year example, assuming nothing has happened to me as a shareholder, I can cancel my policy and I will receive back personally, tax-free in a lump sum amount, all of the premiums and costs that have been attributed to that. So that's just one more way of accessing retained earnings from a corporation. That is quite important to consider, and many don't. Many say that they focus on business owners and on business entities, but they forget to put in all of the little pieces of the puzzle that can actually benefit a business owner. In today's regime, in today's environment, Canadian tax has gone a little bit crazy. So it used to be that dividend tax was only 10%, which was great. So most business owners would pay themselves in dividends, thereby saving a significant amount of tax. The world has changed significantly. Our world has changed significantly, and now dividend tax is almost the same as personal. So you're looking for a high income earner, close to 50% is going to be is what they're looking to pay in tax. So if we can use some of these strategies to help that business owner access their retained earnings for whatever use that they want to do with them, whether it's to use personally to grow their corporation across the border, to fund their future retirement, whatever it happens to be. There's another piece of that, and that's incorporating disability coverage or income replacement coverage. Again, in Canada, if the plans are structured properly, then they can actually be paid for by the corporation. So that would mean that they are now referred to as a wage loss replacement plan. There's certain criteria to adhere to fall under Section 428 of the Income Tax Act. So you need to adhere to certain criteria, having certain individuals protected under this plan, having certain structures put effectively under the plan. So you need a board resolution and so on. But again, if you're dealing with a savvied planner, a savvied advisor, then they're going to take all of these things into consideration.
Beautiful. Well, you covered that incredibly well, Micheline, as I knew you would. Okay, we have one more question to go. And basically it starts with, we're setting ourselves up for our business going forward. And what I want to be able to, here's the question, sorry, I'll repeat myself. Which is the best way of setting myself up so I can access the capital in my operating company if I decide to sell the business? So what we've been talking about all along here is business formation. But now let's turn the tables. It's now time to sell the business. So if you could share a little bit, just briefly, on what your thoughts are on that.
I mean, I love that question and I hate that question at the same time. I would hope that the business owner has a planner who understands from the get-go what the business owner wants to accomplish. So when I'm sitting with potential clients, I guess most financial advisors say, oh, you need to do a financial needs analysis. And absolutely you need to do that. But I like to start with what I refer to as a financial wants analysis.
Yes,
So
well done.
I would say to you, Wayne, it's awesome. I see that you've set up your business. We're sitting down together to to plan what's going to happen in the future. So my first question to you is, if you were to close your eyes today and look to the future, what do you want to accomplish? Do you want to grow this business to a certain size so that when somebody comes to you in the future with a magical check, in the amount of X dollars, you will then sell to them? Is that what you wish to do? Or do you close your eyes and say, I have 2 children, and in my perfect world, I'd like to transition my business to my children. So I'm going to be here and I'm going to keep going until I can't go anymore? Or is it, I'm going to basically die with my boots on? I haven't thought of the eventual sale of my business. I guess that will come if I don't go first. So I want to know what the individual foresees for themselves and their business and their baby going forward. So in this scenario, I'm going to assume, bad word, but I'm going to assume that this individual is communicating with their advisor looking forward. So the advisor has actually said, what do you want to do? And they're saying, I want to build this to a point where I can then sell. Awesome. So I would say, first and foremost, if you're planning to sell your Canadian operating company, you want to start to structure things so that you can efficiently access the capital, your retained earnings, or your accumulated wealth from the company in the most tax effective way. So I would say, first and foremost, set up a holding company. So ensure that you have a holdco structure whereby the holdco can own the business, can own the operating company. And that allows you to separate the operational business from the personal wealth and assets. So you can transfer the ownership of the operating company to a holding company. The holding company would own the shares of the operating company, and the profits from the operating company can be paid to the holdco as dividends, which are usually tax deferred in Canada when it's done within the same corporate group. Now, when you sell the operating company, the proceeds from the sale will then flow to the holding company, and holdco can then distribute the funds to you, the shareholder, in a really tax efficient manner, typically as dividends or through a tax advantage mechanism like a lifetime capital gains exemption. So looking at that and going back to my geeky insurance vehicle, I would then set up that same type of leveraging plan. However, the holding company would be the owner and the beneficiary of that policy, while the payer would be the operating company. And so the operating company could deduct all of the expenses, which it would want to do. But once the sale is made, then there is no taxable disposition on the transfer of ownership of that insurance contract, and all of the assets would then be held within the holding company. So you can have a clean sale of your operating company, having already transferred all the money to the holdco. So you're not paying taxes and you're not at a loss for having sold the operating company.
I'm going to throw a curveball at you on this one.
Oh,
I've been
of course
waiting
you
for
are.
this. I've been waiting for this. Okay, so let's assume that this business owner we're talking about has a problem. Their health is not the greatest. In fact, they may be challenged to even get coverage. So
Okay.
in that instance, let's assume this individual you talk married, 2 kids, cars, 2 cars in the garage, all the trappings. Can they actually add their spouse onto the policy in order to get coverage? Would that work? And would that spouse have to be an officer in that business in order for this structure to work?
Okay, so in Canada, it would be prudent in this case to make the spouse a shareholder of the holding company. And you can even, Class B shares is fine, non-voting shares is fine, as long as they're a shareholder. They would have to be a shareholder to be um, used as one of the insured individuals within that context. You would then put together a structure whereby the insurance was set up on a joint and last to die
Right.
basis, as
Exactly.
opposed to just being um, on the spouse. It would be on both of them.
Right.
Because even if one of the individuals is considered to be uninsurable, a word that I don't really like very much, but it happens every once in a while, even if one of the individuals is deemed to be uninsurable, using a joint and last to die scenario can actually bring down the pure cost of insurance.
Exactly. That's the whole
So
purpose.
we want to pay as little as possible for the cost of the insurance because we want to take full advantage of what that wrapper, that vehicle called insurance does, which is tax shelter investment monies for future access.
Well, you know what, Micheline, you have scored an A plus in terms of making the case that life insurance can be a very effective tool for business owners. Before we wrap up here, um, can you outline just I guess, just as a simple explanation, life insurance, you've outlined some great strategies for life insurance. Is there any other, I mean, you talked about critical illness, you talked about long-term disability. Can you think of any other way that, in the context of business ownership, insurance can be applied or be useful?
Sure. Insurance can be applied or useful when you're looking for funding mechanisms of a buy-sell agreement. So that's life, critical illness, and disability insurance. Now, I would caution individuals who are using disability insurance in the realm of funding a buy-sell agreement that the definitions of disability in the insurance contract marry those within the funding agreement. You don't want two different definitions of disability. You want the funding methods and the triggering methods to coincide with one another. So definitely for buy sell, you can look to key person coverage. So if there's a key individual in the business, again, you want to protect your business from the financial loss that it can incur should something happen to that key person, should
Key
they
man insurance,
become
they still call it key man insurance or key
key
person insurance.
person, yes, it's more politically correct to call it
Yeah.
key person. So key person coverage for sure. A business owner can look at business overhead coverage. So again, if something should happen to them, should they become ill or injured, as opposed to relying solely on their personal income replacement policy to take care of all of the costs attributed to their business, they can look at business overhead coverage. Now, the beauty of business overhead coverage is that it's 100% deductible as a business expense. Uh, if business owners have to take out loans, there is also loan coverage that is explicitly attributed to those individuals. And again, the premiums or the cost for that type of coverage, 100% deductible to the business.
You know, we have listeners all across the United States and Canada, and we have folks watching on our website. And for those folks that are on watching on, we have your contact information on the screen. But for those listening, you know, on either Apple, Spotify, or however they're listening, uh, could you share with us the best way for them to contact? I just imagine there's going to be people who are definitely going to want to reach out to you, Micheline, and I'd like to give them that opportunity. So, what's the best way for them to contact you?
I would say the easiest way to contact me is via email. My furniture is in Vancouver, but I seem to live on Air Canada, so I'm never detached. So email is usually the easiest way to contact me.
And that's at Micheline V at customplanning.financial.com or
That's correct.
Micheline V at customplanfinancial.com. Make sure
Micheline V at customplanfinancial.com.
Perfect.
Yes.
Micheline, I want to thank you so much for joining us. That was a real education on insurance. And again, you made the case that I made that, life insurance is a far more bigger tool or far more important tool than just a simple basic death benefit. And you got an A+ for that. I want to thank you for joining us today. Micheline Varas joins us from Vancouver, British Columbia, and she is a senior partner with Customplan Financial, and she specializes, as she so aptly demonstrates, formulating comprehensive, cost and tax-effective risk mitigation plans. Micheline, thank you very much for joining us today.
Thanks, Wayne.
I look forward to bringing you the 3 Questions podcast, and I hope you find them educational and informative. Please consider liking this video and subscribing to our podcast and YouTube channels. And to receive a notification when our latest episodes have been posted, please click on the notifications bell. Lastly, to schedule an online Zoom consultation with me to discuss your wealth management needs, please click on the link in the description box below, www.onecapital.com/meetwithwayne. Thank you, and we'll see you soon.